December 5th, 2025. Silver hits $59.32 per ounce, a new all-time high. Every analyst on financial television is calling it a bubble. Too much speculation, they say. Retail frenzy. The fundamentals don't support it. But here's what they're not telling you. While silver was climbing 102% this year alone, JPMorgan Chase quietly moved 169 million ounces into their vaults. That's 9% of the entire global supply. And they've been doing this since 2011. 14 years of accumulation, silently, methodically, without fanfare. Now ask yourself this question. If silver really is overvalued, if this really is just speculative mania, why would America's most powerful bank be hoarding nearly 500 million ounces of physical metal? Why would the same institution that paid $920 million in 2020 for manipulating precious metals markets suddenly reverse course and become the world's largest silver whale? I'll tell you why. Because JPMorgan learned something from history. They studied what happened in 1980 when two Texas billionaires tried to corner the silver market and got destroyed. They analyzed how the system changed the rules overnight to crush those brothers. And they realized something profound. If you're going to corner a market, you don't do it against the system. You do it with the system's blessing. What's happening right now isn't speculation. It's the endgame of a 14-year strategy. And when I show you the pattern, when you see what's really unfolding, you'll understand why this isn't about profit. It's about survival and timing and being positioned correctly when the paper market breaks. Let me take you back to 1979. Nelson Bunker Hunt and William Herbert Hunt, sons of H.L. Hunt, one of the richest men in America. These weren't ordinary investors. They controlled billions from Texas oil. And they saw something coming that terrified them. Inflation was running at 14%. The dollar was hemorrhaging value. Nixon had closed the gold window 8 years earlier in '71, severing the last link between currency and hard assets. The brothers watched their paper wealth eroding in real time, so they made a decision. They would corner the silver market, not gold. Gold was too expensive, too watched, too political. Silver was perfect, trading around $6 per ounce in early '79. Industrial demand exceeding mine supply. A shortage building. The brothers started buying physical silver, futures contracts, everything they could get their hands on. By January 1980, they controlled over 200 million ounces, 1/3 of the entire world's tradable supply. The price exploded from $6 to $49.45, an 800% gain in 18 months. Their position was worth $10 billion. They were on the verge of breaking the entire commodity exchange system. And then the rules changed. On January 7, 1980, COMEX implemented Silver Rule 7. No more buying on margin, liquidation only. Margin requirements quintupled overnight. The brothers were leveraged, borrowed heavily. When they couldn't meet margin calls, the whole thing collapsed. March 27, 1980, Silver Thursday. The price crashed from $21 to $10.80 in a single day. The Hunt brothers lost $1.7 billion. They were bankrupted, later convicted of market manipulation, destroyed. Now here's what matters. The Hunt brothers were right about the fundamentals. Silver was scarce. Industrial demand was real. The inflation threat was genuine. They just made one fatal mistake. They tried to corner the market openly, against the establishment. And the establishment crushed them by changing the rules. Fast forward to 2008. JPMorgan acquires Bear Stearns during the financial crisis. They inherit massive short positions in precious metals. For years, JPMorgan is on the wrong side of the trade, suppressing prices, fighting the market. In 2010, they settle manipulation charges. Pay $200 million. Slap on the wrist. But something interesting happens after that settlement. Between 2008 and 2016, according to the Commodity Futures Trading Commission, JPMorgan traders placed hundreds of thousands of spoof orders in precious metals markets. Fake buy and sell orders designed to manipulate prices. The largest manipulation scheme in CFTC history. 8 years. Systematic. Intentional. In 2020, JPMorgan pays $920 million, the largest fine ever imposed by the CFTC for spoofing. They admit wrongdoing. The Department of Justice charges several traders under RICO statutes, racketeering laws, the same laws used against organized crime. Because for 8 years, JPMorgan's precious metals desk was essentially a criminal enterprise. Here's what the indictment revealed. From 2008 to 2016, JPMorgan traders weren't just manipulating prices randomly. They were systematically suppressing silver prices while simultaneously accumulating physical metal, spoofing the market downward, creating fake selling pressure, keeping prices artificially low. And during that same period, they were buying physical silver, massive quantities, stored in COMEX vaults, London vaults, and private facilities. By 2016, when the manipulation ended, JPMorgan had accumulated an estimated 675 million ounces, based on industry analysis and market observers. That's 45% of the world's above-ground supply in 1,000-ounce bars. More than the Hunt brothers ever held. More than any sovereign nation. More than every silver ETF combined. Do you see the difference? The Hunt brothers bought openly, announced their positions, created public attention. JPMorgan did it quietly, with regulatory cover, paid their fines, kept accumulating, and now they're sitting on the largest private silver hoard in modern history. Think about that parallel. 1980, brothers try to corner market, get destroyed when rules change. 2025, bank corners market with regulatory blessing, and now the fundamentals they were betting on are finally playing out. The difference? One was crushed by the system. The other became the system. But here's where the story gets really interesting. Because JPMorgan didn't just accumulate physical silver. They engineered the conditions that would make that silver priceless. Let me show you something about the paper silver market, futures contracts, derivatives, and synthetic exposure. According to COMEX data, current open interest sits at approximately 244% of available registered silver. That means for every ounce of physical silver available for delivery, there are 2.44 paper claims. Think about what that means. If even half of the paper holders demand physical delivery, the system breaks. There's not enough metal. It's fractional reserve banking applied to commodities. And it only works as long as nobody asks for the real thing. Now look at what's happening. November 28th, 2025. The CME Group, the exchange that handles silver derivatives, goes down. Server cooling issue, they claim. 10 hours. During that outage, silver spikes to 56.72 per ounce. When systems come back online, bid-ask spreads are over $1. That's chaos. That's what happens when paper markets face stress and liquidity vanishes. 3 days later, JPMorgan does something interesting. They reclassify 13.4 million ounces from registered to eligible status. Let me explain this. Registered silver can be delivered against futures contracts. It's available. Eligible silver is just stored, not available for delivery. JPMorgan pulled 9% of deliverable silver off the table during peak demand. And here's the kicker. October 2025, silver lease rates hit 30% annualized. Think about that. People were paying 30% interest just to borrow silver for short periods. That's not normal. That's a squeeze forming. That's what happens when physical metal becomes scarce while paper claims multiply. But the real mechanism, the thing nobody's talking about, goes deeper than supply and demand. It goes to the very foundation of how money works since 1971. And JPMorgan knows something that most people don't. You won't believe the name that connects 1980 to today. The receipt is wilder than you think. Because there's a reason silver was targeted twice. Once by brothers trying to protect wealth. Once by a bank trying to control it. And that reason has everything to do with what happens when fiat currencies fail. August 15, 1971. President Richard Nixon closes the gold window. Ends dollar convertibility to gold. Bretton Woods collapses. This is the moment everything changes. For the first time in human history, the world's reserve currency is backed by nothing but faith. Pure fiat. Before 1971, under Bretton Woods, currencies were pegged to the dollar at fixed rates, and the dollar was convertible to gold at $35 per ounce. This created discipline. The US couldn't print unlimited dollars because foreign central banks could demand gold redemption. By 1971, the US only had 10,000 metric tons of gold left, less than half the peak. France was sending battleships to New York to retrieve their gold. Britain requested $3 billion in gold moved from Fort Knox. The system was breaking. So Nixon shut the window. Temporarily, he said. It never reopened. What followed was the greatest monetary experiment in history. 54 years of pure fiat currency. No gold backing. No commodity standard. Just trust in government and military power. Here's what most people don't understand. When Nixon closed the gold window, he didn't eliminate the gold standard. He just moved it. Gold became free-floating, market-priced. But silver remained pegged, controlled, manipulated. Because silver was the real threat. Why? Because silver is more monetary than gold. Throughout history, the gold-to-silver ratio averaged 15 to 1. That reflected their relative abundance in the Earth's crust, about 8 to 1 geologically. For most of recorded history, common people used silver as money while gold was for kings. Silver was democratic money, gold was elite money. When the Hunt brothers tried to corner silver in 1979, they weren't just making an investment bet. They were challenging the post-Bretton Woods order. They were saying, your paper dollars are worthless. Silver is real money. And at $49 per ounce with a gold price of $8.50, the gold-silver ratio was 17 to 1. Nearly historical norms. Silver was threatening to reassert itself as monetary metal. The system couldn't allow that. Because if silver became recognized as money again, if people started hoarding it, converting dollars into silver, the entire fiat experiment would be exposed. So they changed the rules. Bankrupted the Hunts. Sent a message. Silver is not money. Silver is just an industrial commodity. Don't think otherwise. For the next 40 years, from 1980 to 2020, silver was systematically suppressed. The gold-silver ratio exploded. Reached 124 to 1 in March 2020. Gold at 1700, silver at 14. That's geological nonsense. That's financial manipulation. Enter JPMorgan. They understood the game. They knew silver was suppressed. They knew industrial demand was rising. They knew the paper market was over-leveraged. And most importantly, they knew that when the next monetary crisis hit, when fiat currencies started failing, silver would explode. Not because of speculation, because of function. Let me show you the numbers. Global silver demand in 2024, 1.2 billion ounces. Industrial fabrication, 680.5 million ounces, record high. Fourth consecutive year of records. Why? Solar panels, electric vehicles, semiconductors, AI data centers, 5G networks. Solar demand alone, 230 million ounces in 2024. 25% growth year over year. By 2030, projections show 300 million ounces annually just for solar. Each photovoltaic panel uses 15 to 25 grams of silver. TOPCon technology, the new standard, uses 50% more silver than traditional panels. Electric vehicles. Current demand around 90 million ounces. Traditional cars use 15 grams of silver. EVs use 25 to 50 grams. 2 to 3 times more. Global EV sales projected to hit 20 million units in 2025. By 2030, triple that. Do the math. Demand triples. But here's the problem. Silver mine production, 820 million ounces in 2025. Down 12% from the 2020 peak. Recycling adds another 197 million ounces. Total supply, just over 1 billion ounces. Demand exceeds supply. 5 consecutive years of deficits. 2025 projected deficit, 149 million ounces. Cumulative deficit from 2021 to 2024, 678 million ounces. That's 10 months of global mine production. Gone. Consumed, not coming back. Where's the deficit coming from? Above-ground stockpiles, vaults, COMEX inventories. Shanghai Futures Exchange warehouses. These are being drained. Shanghai inventories just hit decade lows. COMEX registered silver down 23% since September. The physical metal is disappearing, but the paper market keeps expanding. COMEX open interest, 195,000 contracts. Each contract represents 5,000 ounces. That's 975 million ounces of paper claims. Registered silver available for delivery. Current reports suggest around 113 million ounces. Ratio, 8.6 paper claims for every physical ounce. This is the bomb. This is what JPMorgan knows. When the paper market tries to settle, when even a fraction of those contracts demand physical delivery, there's not enough metal. Prices don't just rise, they explode. Not to $60, not to $100, to levels that reflect the true scarcity. Remember the Hunt brothers? Silver hit $49.45 in 1980. Adjusted for inflation using official CPI, that's $170 today. But CPI understates real inflation. If you use the methodology from 1980, that number is closer to $300. Now consider this. The supply deficit is worse now. Industrial demand is higher now. The paper leverage is more extreme now. The monetary system is more fragile now. What happens when those factors converge? Let me give you specifics. Federal Reserve meeting, December 9th and 10th. Rate cut probability, 87%. When rates fall, the dollar weakens. When the dollar weakens, commodities rise. Gold and silver historically surged during easing cycles. Gold recently hit $4,212 per ounce. Projections suggest $4,500 to $5,000 by mid-2026, but silver moves faster, more volatile. Current gold-silver ratio, 72:1. Historical average, 50:1. If that ratio normalizes to 50:1 with gold at $5,000, silver reaches $100. If it returns to the centuries-old 15:1 ratio, silver reaches $333. That's the mathematical reality. And JPMorgan sitting on 675 million ounces. At current prices of $59, that's almost $40 billion. At $100 per ounce, $67.5 billion. At $200, $135 billion. At $300, $200 billion. But this isn't about dollars. That's what people miss. JPMorgan isn't accumulating silver to sell it for more dollars. They're accumulating silver because they know dollars are failing. They're accumulating silver because when the reset comes, when the post-1971 fiat experiment ends, whoever controls hard assets controls the new system. Look at what central banks are doing. Buying gold at record rates, repatriating reserves, reducing dollar holdings. China, Russia, India, Turkey, Poland all stacking gold. Why? Because they know the dollar system is terminal. 36 trillion in US debt, 120% of GDP. Interest payments approaching 1 trillion annually. It's unsustainable. But gold is tracked. Central banks watch gold flows. Markets watch gold flows. Silver flies under the radar. It's classified as industrial commodity, not monetary metal. So you can accumulate massive positions without triggering monetary alarm bells. That's JPMorgan's genius. They're cornering the monetary metal that nobody's watching. And when the crisis hits, not if. When we see currency collapse, bail-ins, capital controls, when governments desperately need hard assets to back their failing paper, JPMorgan will own nearly half the world's available silver. They'll write the terms. They'll set the price. They won't be asking for dollars. They'll be asking for power, for influence, for a seat at the table when the new monetary system is designed. This is the mechanic. This is the endgame. Suppress silver for 14 years. Accumulate while it's cheap. Let industrial demand create physical scarcity. Watch the paper market become over-leveraged. Wait for the monetary crisis. Then watch silver reassert itself as money. And own nearly half of it before anyone realizes what happened. December 7th, 2025. We're watching history in real time. The convergence is complete. Record industrial demand. 5-year supply deficit. Paper market leverage at 244%. JPMorgan holding 45% of above-ground supply. Federal Reserve preparing to cut rates. Dollar confidence eroding. Monetary system creaking under debt weight. The pattern is clear. 1980 showed what happens when outsiders try to corner silver. They get crushed. 2025 shows what happens when insiders do it. They win, but the stakes are higher now. In 1980, it was about wealth transfer, billions changing hands. Today, it's about system survival. The entire post-Bretton Woods monetary order is built on faith in fiat currency. When silver breaks the paper market, when prices explode and people realize the leverage was a lie, that faith shatters, and it's happening fast. Markets that took decades to build can collapse in days. The Soviet Union went from superpower to non-existent in 900 days. Britain lost its empire in 20 years. Spain took longer, but the result was the same. When the foundation cracks, when the illusions break, the descent is rapid. The question isn't if silver reaches $100, $200, $300. The math guarantees it given current supply-demand dynamics. The question is timing and positioning, and whether you understand what you're witnessing before it's too late. JPMorgan understands. They've been positioning for 14 years. They've paid their fines. They accumulated their metal. They're ready. The system that crushed the Hunt brothers in 1980 now profits from their strategy. Because they learned the lesson. You don't fight the establishment. You become it. So here's your choice. You can dismiss this as conspiracy theory, as speculation, as fear-mongering. Or you can look at the data, the $920 million fine, the 675 million ounces, the 244% leverage ratio, the 5-year deficit, the record demand, the collapsing inventories, the closing gold window in 71, the Hunt brothers in 80, the pattern completing now. Are we wiser today, or are we walking the same path in better suits? History doesn't repeat, but it rhymes, and right now the rhyme is deafening. If you want to follow along as this unfolds, hit subscribe. Because when stage 6 arrives, when the paper market breaks and prices go vertical, you'll want to understand what happened and why. The answers aren't hiding in the future. They're written in the past, and I'll show you where to look. Click the next video for another eye-opening analysis. Thanks for watching.